One of the most common pieces of financial advice people hear is just save more money. It sounds really responsible. It sounds conservative. It sounds safe. But in 2026, you guys, that advice it's just outdated and it's actually dangerous. Saving alone, it does not build wealth. A quick case is back in 2020, if you had $100,000 in your bank account and you spent it in 2025, it bought you $75,000 worth of goods. And that's just the facts. That's just the data based on the money that was created during COVID. Not to talk good or bad, that's just the way it is. So if value of the dollar is sinking that quickly, and another stat is if you look at history and you go back far enough, 100% of currencies have been replaced or gone to zero. And the US dollar, as of 1971, is a currency. So based off of the facts, based off of the data, looking at history, saving dollars as your end game is very risky. And that's why we say it's dangerous. So this is great example of exactly how it's eroding purchasing power. So today we're going to break down why saving money and saving more, it fails in this modern market, and how inflation is quietly punishing savers, and I'd even say stealing from savers. And this is what high income professionals and investors should be focused on instead. So saving isn't the problem, you guys. Relying on it is. I have cash for short-term stuff. And a lot of the folks that I work with who are very savvy investors, they still have some cash. I'm not saying you drain your bank account to zero. What I am saying is long term, if you're relying on the dollars to be there in retirement, that's the part where you might want to be looking into owning things that are real. So save more money made sense decades ago, you guys. This is when inflation was a lot lower and or before the dollar was a currency. So before 1971, you could trade your dollars in for gold and silver. And it was a form of trade that was actually held value. It was money. Interest rates as well on savings were much more meaningful. Nowadays, if you can get 3 or 4% on a savings account, you're doing pretty dang good. And then asset prices were cheaper relative to income a long time ago. So you could save consistently, you could earn yield in a bank or a bond, you could buy assets later without massive opportunity cost. In that world, it simply doesn't exist anymore. So today, the economy, the environment, it's changed, but the advice has not. If you notice, most people are still talking about saving dollars. So inflation, it's the silent tax. So inflation, it does not feel dramatic day to day, right? It's something that is happening slowly. You're not really aware of it, but over time, it's destroying purchasing power. Just like I shared from 2020 to 2025, $100,000, what it bought you 5 years later, only $75,000 worth of good. So that means money sitting, it still loses value. And it really is currency sitting loses value. And even moderate inflation, it compounds aggressively over years. And savers think they're being conservative, but they're quietly falling behind and their lifestyle is getting smaller and squeezed and they don't know why. So cash rarely keeps up. Most savings, these vehicles, they barely match inflation, if at all. And after taxes and inflation, real returns on savings are often negative. You're not actually growing wealth. You're preserving far less. Here's an inverse of it. While your money sits idle in the bank account and loses value, here's how the approach works with real assets. As assets appreciate, they go up in value, because they're continuing to print more currency. Also, while you own the asset, you should have income coming in as passive income that's paying you real time right now. In markets, they're going to move on with or without you. So the biggest cost of savings too much is missed ownership. Saving delays risk. It does not eliminate it. And I would say if you save for too long, it actually makes the risk worse because of the fact that they continue to print so much currency. And here's why high income earners fall into this trap. So, professionals, they often default to saving, doctors, attorneys, executives, business owners. It's because their income is strong and their risk tolerance feels lower and their time is limited. So you've got this excess income that piles up in cash. On paper, their balances look kind of impressive, right? But in reality, their wealth is just not compounding. The cash isn't working for them. Inflation is doing the damage quietly over a long period of time, and it evaporates all of the capital that's been saved. So high income plus idle capital, not a strategy that's going to create financial freedom in the future. What smart investors focus on instead, you guys, is cash flow and not piles of cash. Cash is a tool. It's just part of the equation. 50% I always say for my snowboarding career was, how do I make the money? The next 50% or half is, what do I do with the money? It's a tool, not the goal. And smart investors, they're focusing on assets that are going to produce income streams. They're looking for predictable distributions. Multifamily can be predictable, and there's times where it cannot be. Sometimes you may have to get into triple net lease assets where it's extremely predictable. But one of the biggest things that's undeniable is, as the market shifts, and we've gone through like we have over the last 4 years, the asset class that was less predictable is becoming much more predictable because the price of the deals have come down significantly. So you're buying them for much cheaper. Plus, the debt's getting to be more fixed on a common basis. But you got this inflation adjusting revenue. That's the biggest thing with owning real assets. You own something that has revenue that is adjusting and expanding as inflation continues to happen. My goal is ownership over accumulation. So wealth is built by owning productive assets, right? Real estates, different businesses, income generating investments. Ownership, it creates this leverage. It's not financial leverage, but time leverage. And as long as you're in these deals or in the real world of owning things that are real versus just paper is something that's fake. It can be printed, right? They can push some buttons at the Federal Reserve and boom, trillions are created. When you own things that are real, gold, silver, real estate, you're in a position where that stuff can't just be created out of thin air. So there's a finite amount of it. And that generally goes up in value or holds value as they continue to quickly inflate the currency away. There's one thing that needs to be deeply understood, though, with all investing, especially with real estate and multifamily, and that's structure and discipline, you guys. And there's been some great lessons and hard lessons that have been taught to a lot of firms over the last 4 years. But number one is conservative underwriting. And conservative underwriting does not mean you're going to underwrite like the past has been, because there's been a long time, say from 2019 to 2022, where rents were going up and steep. And if you continued to underwrite like that, you got burned when the market shifted, burned badly. You got to have a margin of safety as well. We call these reserves. You want to have a bunch of excess cash on hand for potentially CapEx for you to add value, right? You want to come in and upgrade the property so you can be the shiny gem in the submarket. Or just in case things don't go well, you need to have reserves to get you through the down times, to get you back to a place where you can sell when it's ideal to sell. And in these deals, it's really important to be thinking long term. What really happened with a lot of the flippers who are no longer here from back in 21 and 22 is they got into deals thinking within 12 to 18 months they were going to sell, refinance, flip for this huge gain. Well, when the music stopped and the Fed raised rates, all that capital got tied up. All those deals went underwater. And those short-term thinkers did not plan for a downside scenario. And so if you're in the short-term flipping mentality, you're going to structure the deal very different than if you're going in for a 7, 10, or potentially even a 15-year hold. And if you go for a 10 or 15-year hold, it doesn't mean you can't still get capital out tax-free through a refinance. You totally can. So thinking long-term is critical, especially if you're going to be a great real estate investor. That's my perspective. And then not chasing returns, you guys, managing risk intentionally. And when I say chasing returns, I mean that as an investor, you go and look at someone's spreadsheet and they show you how they're going to double your money in 3 years, or they're going to give you a 25% IRR. That's chasing returns. That's me saying, oh, look at this spreadsheet. Wow, they're going to get me a 20 to 25% return on my money. I'm going to go with that deal over the deal that says they're going to get 15% on my money. That question right there of I'm going to go with a higher investment because they're advertising a higher return versus a lower return, completely irrelevant what's being advertised. What matters is the structure of the deal, the underwriting of the deal, and how well you know that deal sponsor. I see it time and time again, people getting burned left and right, chasing these high returns. And then, real estate, especially multifamily, it addresses the failures of just saving very well, right? It hits cash flow, streams of income. It hits inflation protection because you can drive net operating income. You can come in and do a value add strategy. Let's say you upgrade the interior units, put in new quartz countertops, some stainless steel appliances, new cabinet faces, maybe some new flooring, new fixtures, and you might be able to bump rents $200 or $250 to match the competitors. That's a way you can drive value. You can force value. It's NOI increase. Another thing is it's a tangible asset. You can go touch this thing. You can see it. There's long-term demand in the right submarkets, right? There are more people that are forced into renting right now than ever before. And that's purely because the cost of a mortgage and homes, it outweighs what people can afford. So not that they want to not own the home. They would love to own a home, but they can't, and they're forced. And you have more and more people who are being forced into the rental market. And when you structure this correctly with conservative debt, I'm going to say 70% or less loan to value. Strong markets. When I say strong markets, there's job growth, population growth. It's a landlord friendly state. You've got strong cash flow, and then you have a disciplined operator that knows what they're doing with a decade plus of experience. Real estate turns into this idle capital into working capital. It turns into an ability to create value where very few others are able to take advantage of it. And the way Granite Towers ties this in is we focus on fundamentals. What does the data tell us about that submarket? What are the current competitors doing today that we can verify and match or beat? How can we come in with our team, with our 6 uniques and add value to an asset that the previous owner may not have been able to do? Maybe they were cash strapped. Maybe they were over leveraged. Maybe that over leverage took all their cash flow into the deal and now they have deferred maintenance. Getting your structure right is absolutely critical across asset classes. So instead of just save more money, the better advice in 2026 is save enough for liquidity and protection. Of course, you got to have the basics. I'm not going to sit here and act like I don't have any cash saved. That's not what I'm talking about. Definitely have the basics. And if you don't have the basics yet, that's your first step. It isn't going and buying a $1 million apartment with your first 10 grand. That's not the right place to be. Step 1 is you got to have the cash saved in an emergency account. Number 2, after you get that and you save extra, you're going to deploy the rest intentionally, thoughtfully. You're going to convert that income, that extra capital that you don't need beyond your emergency account, and you're going to put it into assets, and you're going to let the capital work instead of just sitting still. So to wrap this up, you guys, saving money isn't wrong. It's stopping there. That's what's wrong if that's all you're doing. And in today's environment, inflation, it's going to punish your idle cash. It's as simple as that. It's a fact. And opportunity, it purely rewards ownership. So the question is how much do you have saved up? And once you're beyond that, how hard is your excess money working for you?